Anyway, let's go on to our action plan. No use just talking. What do we do about it? The main point in the action plan is that you should advise your clients to diversify, prepare for a very wide range of possible outcomes because nobody really knows what will happen. The second point is that in your decision-making and analysis, please keep an eye on the physical world, not the financial world. I will explain later what I mean, but essentially, look at what people really eat, what they spend money on, what they like, the supply and demand, not on all these funny numbers you see on the Bloomberg. That's the financial world. That's becoming less and less important. Trust your brain, your eyes, and your ears. Don't just keep reading these funny things in the newspaper. For me, I have a team of about 40 people doing research for me in the Value Partners team. We've been doing research for 18 years. Our preferred sectors are energy, coal and oil, precious metals, especially gold, anything related to farming and agriculture and food, China-related stocks, and companies with really big brand franchises, because these are the guys who can, if there is price increase for the raw material, they can pass on the cost to the customer. Just briefly about oil, look at this table. You will see that China, for example, right? If they were to increase their per capita GDP, simply means their income, to even the level of Mexico or Malaysia or Russia, the demand for oil in China will increase an extra 15 million barrels a day. Today, the whole world oil export market is only 87 million barrels a day. And we're not talking about China consuming as much oil as UK or France, only middle income country. This will happen, I think, by 2015 to 2020. Frankly, there is not enough oil physically in the export market to satisfy the Chinese requirement. So I actually don't know what will happen. I think the only real solution is for the developed countries of the US to consume less oil, or the price of oil will have to go crazy. So it's a form of rationing. This is what I mean by physical world, you know. Oil is a very physical thing. Next, we talk about gold, which is very controversial and has been going through a price correction in recent weeks. For people like me, gold is simply, you know, it's an insurance policy against the government's printing too much paper money. So it eventually collapse the confidence in paper money. Personally, I think that it is okay to put up to maybe like 10% of your wealth in gold. Remember, if you have US dollars now, actually you're just holding a piece of printed paper. There's nothing behind it except a kind of a promise from the US government to pay you. But would they really pay you back? I don't know. So just two quick points about gold, and we go to the next topic. First, the size of although the price of gold has gone up a lot, the size of the US government debt has gone up even more, much more. So in fact, gold is now looking even cheaper to me in relationship to the price of the borrowings of the US government. Secondly, for physical observation, very little new gold is available now. The gold mines are becoming empty. Look around the world, South Africa, North America, China, the gold mines are very difficult to access the gold. You have to dig very deep into the ground for just a little gold, not much new supply. Here's another physical world thing. The truth is, because of the growth of the human population, the amount of land available for farming per human being is getting less and less. You can see it here. And by the way, also as people like mainland, people in mainland China get richer, they are changing their diet from one based on vegetables and grains to one based on meat. Meat means cattle and pigs. They require a lot more land because they eat more corn and other kinds of food, grain, to feed you, to get the meat. With China, I know that some of you read about possible hard landing for China. Hard landing means the economy just crashed very badly. I don't think it will happen. The Chinese government still have huge reserves to fight, unlike the US government, against any kind of real problem. And also some people say China is very dependent on exports, but look at the real world. The truth is exports are no longer an important contributor to China's economic growth. Growth now comes from domestic spending and consumption and local domestic investment. China has become less and less dependent on exports for its growth. The domestic consumer market in China is a very good story, and it will get even better. According to this research from Deloitte, the accountancy firm, China already has the world's second largest number of households with a net worth between 5 million to 30 million US. This is the sweet spot for consumer spending. They now have more consumers in this category in China than countries like Italy, Japan, or UK. To summarize the big picture, what can we learn from history about our three scenarios and what should we do? One way is to look at books like this one, which is one of the best books I have read. Barton Briggs was the big guy from Morgan Stanley. He was very famous in the 1990s. He was 30 years in Morgan Stanley and was ranked #1 global strategist for many years. So he wrote a book which I read about 2 years ago, and I remember it, called Wealth, War, and Wisdom. It's a study of World War II from the investment point of view. What happens when your country, the global markets, is hurt by war, your government is overthrown, etc.? What are the investments that can protect you? So let's look at the summary of that. First, he looked at the so-called lucky countries. That means those countries that didn't get invaded by others or who won the war. Obviously, these are countries like Australia, UK, USA. Notice that under these scenarios, the best performing asset class is equities. That means stocks. Stock market was even able to outperform inflation. And this is not just the World War II, but these are numbers from the year 1900 to the year 2000. So 100 years of history captured here. In summary, for these lucky countries, the return per annum adjusted for inflation was 6.5% for stocks, less than 2% for bonds, just over 1% for money market instruments, and inflation was 3.5% per annum. I think these figures are, to me, they are very interesting. Unfortunately, China was not one of the lucky countries because China got invaded by Japan. So let's go to the next exhibit, the unlucky countries. The unlucky countries, as I mentioned, are those that got invaded, surrendered, or were defeated, like Japan and Germany. Here, the #1 thing to notice is that inflation was very high, big problem, volatility was very high, but equities was still the best performer. In fact, the stocks were the only one with a positive return over those 100 years after adjusting for inflation. If you had bought bonds or bills, you would have ended up losing money. So there are 2 points. One is try to make sure you are in a lucky country, the one that doesn't get defeated or invaded. And 2, prefer equities. Barton Briggs himself recommend people to put up to 75% of their return in stocks and spread out the rest. And he even suggests that if possible, for part of your wealth, maybe 5–10%, you should buy a farm. Buy a farm and make sure there's a lot of food you can grow yourself. And I notice he's not actually joking. You know, he actually write it down very seriously. But I think for most of us in Hong Kong, this is not a very practical advice. Okay, so that's the summary of this guy who is ranked #1 and took a lot of trouble to do all the research. My last point before I leave is that if indeed equities is the solution or the main but not the only solution to these difficult scenarios that we now face and the uncertainty, what is the best way to invest in the stock market? Now, the most important point about the stock market you should remember is that stock markets are not efficient. There was a theory about efficient markets theory. Now, this is totally untrue. In real life, stock markets do not price things correctly. So The value investing, which is the method we use, in my opinion, is almost the perfect way to take advantage of this. Value investing, in very simple language, means try to make money from stupid people, people who make mistakes. Many people who go to the stock market are very little research and are very stupid, but they have some money, so they just treat the stock market like casino. You have good research, good discipline, then, and you're professional, you can make money from these people. Even though the overall market is not very attractive, even though the economy may be slow, there are always these stupid people who shouldn't go to the casino. You make money from them. It's much easier than making money from economic growth. Okay? That's my conclusion. Thank you.